Welcome back, focused learners. I am absolutely thrilled to have you here today because the market data from June 14, 2026 reads literally like a movie script. We are looking at a market caught in this massive, explosive clash. On one side, we've got paralyzing bearish fear completely gripping retail traders, but then on the other side, we're seeing the entry of colossal, bullish institutional forces and some truly groundbreaking technological shifts. We've actually styled today's explainer with these really vibrant, dynamic comic book visuals because honestly, it perfectly captures the epic, almost anime-level clash we are seeing in the market right now.
Okay, so let's dive right into this, because we need to unravel a pretty huge mystery today. How in the world is the global cryptocurrency market cap sitting at a massive $2.2 trillion, yet the underlying sentiment is just entirely fractured? I mean, who is actually moving this capital if everyone is seemingly terrified?
To really understand the fear, think of the market's current state kind of like a critical, flashing red health bar in a video game. The bit-degree Crypto Fear and Greed Index is sitting at a mere 13. Now, anything under 20 represents extreme fear. This tells us everyday retail traders are highly anxious, they're anticipating a drop, and they are incredibly hesitant to take on risk. The broader sentiment among the general public right now is undeniably bearish.
But then we look at the actual numbers. Despite all that extreme fear, we are seeing a modest but very real 0.9% market recovery over the last 24 hours. That brings the total market capitalization up to $2.2 trillion. Major assets like Bitcoin, Ethereum, BNB, and Solana, they're actually posting gains. So what we're really witnessing here is the sheer resilience of the broader market. It's absorbing that heavy downward retail pressure because a completely different type of buyer has entered the arena.
Section 1. The SpaceX Effect and Tokenized Equities.
And that brings us to our first major bullish catalyst stepping onto the battlefield, right where the crypto world and traditional tech giants are colliding. But before we get into the weeds on the data, let's make sure we clearly understand the mechanics. Real-world asset, or RW tokenization, is basically just taking a traditional financial asset, like a share of a company's stock, and creating a digital mirror of it on a blockchain. This allows the asset to be traded 24/7 globally, leveraging crypto infrastructure for traditional finance.
Now, what's super fascinating here is how a single, highly anticipated traditional finance event triggered massive on-chain volume. Elon Musk's SpaceX just debuted its monumental $75 billion IPO on the NASDAQ at $135 a share. While simultaneously, Backpack Securities, which is a financial arm of a Solana-based exchange, launched tokenized SpaceX shares under the ticker SPX. Just the launch of this single speculative product drove over $35 million in trading volume and caused Backpack's own native BP token to surge 27% to $0.347 in a single day.
However, we definitely need to temper the hype a bit. Structural value is very different from a speculative spike. That BP token had actually already rallied 87% earlier in the month, just on the announcement of this brokerage arm. So for this to represent a true long-term market shift, Backpack has to prove it can sustain a continuous pipeline of tokenized offerings. They can't just ride the wave of a single massive IPO and call it a day. So while decentralized exchanges are mirroring Wall Street assets on-chain, it really begs the question, can Wall Street itself sustain this momentum from the traditional side? Like, are traditional institutions actually ready to dive deeper into the crypto ecosystem?
Section 2. Institutional expansion via active ETFs.
While the answer is a resounding yes, and they are bringing heavy artillery, we are seeing a major institutional expansion via active ETFs, which is a big step beyond simple spot products. The U.S. Securities and Exchange Commission just approved a rule change allowing T. Rowe Price to list an actively managed crypto ETF on the NYSE Arca. Unlike a spot ETF that just holds Bitcoin, this fund will actively manage a diversified portfolio of 5 to 15 different crypto assets. We are talking about Bitcoin and Ethereum, sure, but also altcoins like Solana and XRP.
This approval is a massive structural green light for diversified institutional capital. It means the big money is no longer just betting on Bitcoin's solo price action. They are building sophisticated, diversified portfolios. And honestly, this kind of capital inflow is exactly what can help stabilize the overall market and give those altcoins their own robust, institutionally backed momentum.
Section 3. The Global Regulatory Sledgehammer.
But hey,
Every dynamic market needs its opposing forces, right? And we are seeing a real push and pull clash happening globally right now. Over in the US, the CFTC is issuing a no-action letter that allows digital commodity futures to remove expiration dates, essentially giving a bullish nod to true perpetual futures, which boosts liquidity. But then look at the Philippines. The central bank there has drawn a hard line, completely banning the listing of anonymity-enhancing privacy tokens and demanding these exhaustive life cycle assessments for all virtual assets. It's a huge clash between liquidity expansion and strict structural control.
And add to that the heavy enforcement we are seeing in India. They are tightening reporting rules to a per-transaction basis for the 2026 filing season. Authorities have already issued over 44,000 tax notices, uncovering $104 million in undisclosed income. The global cost of compliance is literally skyrocketing. So this regulatory tightening, that's the heavy sledgehammer swinging against those bullish institutional inflows we just talked about.
Section 4. The Boss Fight. Bitcoin's 67K resistance.
All of these macroeconomic forces, the extreme fear, the RWA tokenization, the active ETFs, the regulatory hammers, they are all manifesting right now on the charts in what we can really only call an epic technical boss fight. Let's break down the critical numbers. Currently, Bitcoin is trading near $64,354. Below it, you've got that $60,000 psychological support level, which has heroically held the line 3 separate times this month, preventing a slide that could have triggered total retail capitulation. But right above it lies a massive wall of immediate resistance between $65,000 and $67,000. Buyers and sellers are violently colliding right in this narrow channel. So the absolutely crucial takeaway here is this. For the bulls to actually take control, they have to shatter this $65,000 to $67,000 resistance zone with a clean, decisive break. If they fail and the price action gets rejected here again, Bitcoin risks sliding all the way back down to test that $60,000 floor. This is the technical bottleneck deciding the market's immediate fate.
Section 5. The Emerging Machine Economy.
Now, while retail traders are out there sweating over these technical charts, the industry's largest players are quietly building what looks like the market's final form. They are stepping entirely away from human behavior and preparing for the emerging machine economy. This is, hands down, the most mind-blowing development we're tracking. Heavyweights like Ripple, MetaMask, and even traditional giants like MasterCard are shifting their focus. They aren't just building wallets and payment rails for you and me anymore. They are building infrastructure optimized specifically for autonomous AI agents. They're positioning high-throughput blockchains like the XRP ledger and Solana to be the settlement rails for machines that think and transact at lightning speed.
Think about how this sequence actually plays out. Step 1. An AI agent, maybe buying server space or pulling data, initiates a real-time machine-speed transaction. Step 2. Networks with fast finality and low fees settle that transaction instantly. And Step 3, this is the game changer, the true utility of these networks completely decouples from human retail trading sentiment. AI doesn't care if the fear and greed index is at 13, it just needs predictable fees and instant settlement to operate continuously in the background.
Which brings us to our final, rather provocative question. As we sit here and watch retail fear clash with institutional ETFs today, are we simply watching the end of the human-driven era of crypto? If billions of autonomous AI agents become the primary users of these networks, transacting continuously in the background of the global economy, are machines the true future of this technology? That is exactly what we will be exploring in our next explainer. Until then, keep learning, stay focused, and I'll catch you next time.